Thank you for listening to this PYA webinar recast. PYA is pleased to offer this alternative way to access our thought leadership. This is a recording of a previously delivered webinar. The information is accurate as of the date of the original event. The video recording, slides, and associated material for this and all PYA webinars are available on our website at pyapc.com. This podcast is for educational purposes only. It is not intended to be used as legal advice or an official opinion.
Good afternoon, everyone. Welcome to today's episode of PYA's Summer CPE Symposium, Hot Topics in Healthcare, Day 1. Our second presentation of the day is One Big Beautiful Bill Impacts, Medicaid Cuts and State Tax Implication. As this event is for CPE credit, we have a few additional steps that we'll take in order to comply with NASBA's requests. Attendees will be provided with 4 polling questions for this session. Responses are documented electronically. In accordance with NASBA, attendees must respond to at least 3 polling questions within the allotted time in order to receive CPE credit. At the close of the session, a post-event survey will also be provided for attendees to submit feedback regarding their webinar experience. The polling questions and post-event survey must be submitted for proof of participation today. Credits will only be earned for sessions attended in their entirety. Your CPE certificates are downloadable via the continuing education pane once you have completed all requirements. We've posted a PDF copy of the presentation slides for your reference in the resources pane. Also, all sessions will be recorded and you'll receive an email later today with a link to a copy of the slides and a recording of the webinar. You may submit questions directly to today's presenters by typing a message into the Q&A pane. We'll collect these and the presenters will address them individually via email after the event. Registration is still open for the remaining summer symposium sessions, and we'll hope you join us. For more information and to register, visit the Thought Leadership section of our website at pyapc.com. With that, I'd like to introduce our presenters, Ramzi Fadayel and Patrick Birmingham.
Thank you, Jennifer. Just to introduce myself, I'm Ramzi Fadayel. I'm a manager in our Revenue and Compliance Advisory Department, and I specialize in Medicare and Medicaid cost reports.
And I am Patrick Birmingham. I'm a manager in our Tax Services Department, and I specialize in partnership and corporation taxes.
All right, thank you, Patrick. Well, let's discuss the agenda and learning objectives for today's webinar. So first, I'm going to discuss the One Big Beautiful Bill Act's impact on Medicaid. And as a quick side note, from now on in the webinar, I'm going to refer to the One Big Beautiful Bill Act as OB3, so it's a little bit less of a mouthful. We'll discuss the details of spending cuts to programs, potential impacts of those cuts on providers, and then we'll summarize the spending cuts by program and by year. Patrick will then discuss the state tax implications, including tax funding strategies, pros and cons of tax increases, multi-state budgeting funding strategies, and he'll go over a couple of case studies. So we'll start with OB3's impact on Medicaid. So today we'll discuss OB3's impacts on provider taxes, state-directed payments, community engagement requirements, including the potential effects on Medicare disproportionate share hospital payments and the 340B drug pricing program. We'll also discuss a few other Medicaid provisions, and then we'll summarize the spending cuts by program and by year. So first, I'd like to give a brief background on the Medicaid program. So Medicaid is jointly funded by both the individual states and the federal government. The state Medicaid expenditures are eligible for a federal matching assistance percentage, or FMAP. Now that's the share of Medicaid costs in a given state that is paid by the federal government. This percentage can range anywhere from 50 to 83%. among the states, and it's based on a state's per capita income level. So the lower that a state's per capita income level is, the higher its FMAP. To go over a quick example of this, if a state's FMAP percentage is 60%, that means the individual state is responsible for 40% of its Medicaid expenditures. So for every dollar that the state spends to finance Medicaid, it receives $1.50 from the federal government, and that results in $2.50 of total available funding. So I'll also give some background on provider taxes, since that's one of the areas that's going to be impacted by OB3. So provider taxes are fees that the states collect from hospitals, nursing homes, and managed care organizations to help them finance their share of the Medicaid program costs. Now, this provider tax revenue can be used for multiple different things. It can be used to finance an increase in the Medicaid base payment rates to providers, and it can also fund supplemental payments. And a few examples of supplemental payments are DSH payments, upper payment limit payments, and state-directed payments. So I'll briefly discuss a few of those. So Medicaid DSH payments support hospitals that serve a high number of low-income, uninsured, or Medicaid patients. And upper payment limit payments supplement Medicaid payments up to certain levels so that providers are getting paid by Medicaid at levels that are sometimes equivalent to Medicare rates, or even in some cases equivalent to the average commercial rate. State-directed payments are payment arrangements in which the state directs Medicare managed care plans to use specific provider payment methodologies, and those payment methodologies often result in increased reimbursement for providers. So let's discuss some of the OB3 impacts on provider taxes. Now, some of this content can be somewhat complex, so I'll read through this slide and then I'll take some time to explain it and summarize it. So as of July 4th of last year, states cannot impose any new or increase any existing provider taxes. In addition, there's a decrease in the threshold for the hold harmless provision for expansion states. Now, the hold harmless threshold is currently at 6% of net patient revenue. But for expansion states, that would be states that expanded Medicaid coverage under the Affordable Care Act, they must reduce their existing provider taxes by 0.5% each year until it reaches 3.5%. Now, the reductions would start in 2028. If a state had provider taxes of 6%, it would decrease by 0.5% each year until it reached 3.5% in 2032. Now, this reduction does not apply to provider taxes on nursing facilities or intermediate care facilities. Now, for non-expansion states, they can maintain their existing pre-approved provider taxes, but they cannot impose any new ones or expand existing ones. So just to summarize a little bit, essentially, there's currently a safe harbor provision that allows states to tax their providers, their hospitals, up to 6% of net revenue. Okay, but as a result of OB3, expansion states have to reduce that down to 3.5%. Now, non-expansion states do not have to reduce it. If they had a pre-approved provider tax that was 6% of net revenue, they do not have to reduce it, but all states, whether they're expansion or not, cannot create any new provider taxes, and they cannot expand existing ones. So the Congressional Budget Office has estimated that this provision will result in a $226 billion reduction in federal spending over the next 10 years. So now let's briefly discuss what state-directed payments are, and then we'll discuss how OB3 is impacting them. So state-directed payments are, again, payment arrangements through which a Medicaid state agency will direct managed care organizations to use specific provider payment methodologies or payment rates to support state policy goals. Now, this is often used to support hospitals, academic medical centers, rural providers, and what ends up happening is it results in healthcare providers often receiving higher payments from the MCOs than they otherwise would. Now, before OB3, CMS had allowed states to require MCOs to pay up to average commercial rates to providers. Now, average commercial rates could be sometimes 200, 250% or more of Medicare payment rates. And remember, because of the FMAP, or the Federal Matching Assistance Percentage, these high STPs increase the individual state's portion of Medicaid spending, which in turn increased the matching funds from the federal government. So how is OB3 going to impact state-directed payments? Well, as a result of OB3, there can be no new state-directed payments that exceed 100% of the Medicare rate in expansion states and 110% of the Medicare rate in non-expansion states. Now, a quick sidebar, that prohibition, it doesn't count if the STP had been submitted for approval to CMS before May of last year or before July of last year for rural providers. Now, if there is not a Medicare rate, if one doesn't exist for a specific service, then any new STPs cannot exceed the Medicaid rate specified in the state plan. Now, what if a state already has a pre-existing STP that exceeds the applicable limits of 100% for expansion states and 110 for non-expansion states? Well, in that case, the state must reduce its STP by 10% each year, beginning with rating periods on or after 2028, until they get down to their applicable rate limit. Now, unlike what we discussed earlier with provider taxes, there is no exception for this STP provision for nursing facilities or intermediate care facilities. So the Congressional Budget Office has estimated that there will be a $149 billion reduction in federal spending as a result of this provision over the next 10 years. Okay, so we've covered OB3's impact on provider taxes and state-directed payments. Now let's discuss another change, which is the community engagement requirements for Medicaid eligibility. Now, these have been in the news lately, so you may have heard a bit about them, and they will be going into effect soon. So effective January 1st of next year, states will be required to condition Medicaid eligibility for the expansion population. Now, this applies to patients who are enrolled in Medicaid through the Affordable Care Act, expansion plans, or equivalent coverage. So for adults who are not disabled or who do not meet the exceptions, age 19 to 64, in order for them to qualify for Medicaid, they will have to participate in 80 hours or more per month of community engagement activities, and we'll discuss what those are in a minute. And then the federal government has appropriated $200 million in fiscal year 26 to assist states with implementing these new requirements. So what does it take to meet these new community engagement requirements? Well, a Medicaid applicant must either work at least 80 hours in a month or perform at least 80 hours of community service. They could also participate in a work program that would be a federally authorized workforce training program or a state-run employment program or training program. Now, they can also be enrolled in an educational program for at least half time or some combination of all of those. Additionally, they can have a monthly income that is the minimum wage times 80 hours that will also qualify them. So along with the community engagement requirements, there's a responsibility for the state to verify that any Medicaid enrollees are meeting these requirements. So the states must verify that an applicant met the requirements for at least 1 month prior to their application. And in addition, they must conduct renewals of eligibility every 6 months. Now, before OB3, these renewals were required every 12 months. Initially, applicants can self-attest to meeting these community engagement requirements, or they can self-attest that they meet the requirements for an exemption. And we'll discuss those in a minute. But after the initial period, states will be required to verify that they're meeting the requirements. Finally, states can request up to 2 additional years if they need more time to fully implement these requirements and the verification process, but they would have to get multiple extensions approved from CMS to reach that 2 years. And in the meantime, they would have to show that they have been making a good faith effort to implement the requirements and verification procedures. So I mentioned before some exemptions. So there are exemptions to the community engagement requirements for individuals who are parents or guardians of dependent children, pregnant, veterans with a total disability rating, medically frail, for those who meet the temporary assistance for needy family work requirements or are receiving SNAP benefits, among a few others. Now, in addition to those exemptions, states may also allow short-term exceptions for individuals who are, receiving inpatient hospital services, who might reside in a county that is in a presidentially declared emergency area, or have to travel long distances for a serious medical condition. Now, this new provision of OB3 has a large impact projected by the Congressional Budget Office. They're projecting over $300 billion in federal spending reductions over the next 10 years. And in addition, they're estimating that approximately 5 million people will become uninsured as a result of this. So what does this all mean for hospitals? Well, the increased eligibility requirements from these community engagement requirements could result in procedural disenrollments from Medicaid, which could result in lower Medicaid patient volumes at some hospitals, and that could correspond with an increase in self-pay and uninsured volume. Now, that decrease in lower Medicaid volume could also result in a lower Medicare DSH percentage, and we'll discuss what Medicare DSH is and its implications in a minute. Hospitals could potentially lose qualification for Medicare DSH add-on payments, and they could also potentially lose qualification for the 340B drug program. So one of those impacts that we talked about on the last slide was the potential impact of OB3's community engagement requirements on Medicare DSH. Now, this can be somewhat confusing because we've been talking about Medicaid this whole time, and now we're saying Medicare. But the reason we bring this up is because Medicare DSH payments and the Medicare DSH percentage is affected by a hospital's Medicaid patient volume. So we'll go into that in a little bit of detail. So there's 2 different types of Medicare DSH. There's the traditional DSH and uncompensated care DSH. Now, uncompensated care DSH is driven by a hospital's cost of uncompensated care. That comes from charity and bad debt. When I'm talking about Medicare DSH today, I'm focusing on the empirically justified or traditional DSH, because that DSH is driven by a hospital's Medicaid eligible days. So it's ratio of Medicaid eligible days to total inpatient days. And as a result, that traditional DSH is what could be most directly impacted by the new community engagement requirements. So why does this matter? How does Medicare DSH impact hospitals? Well, there's two main impacts. The first is Medicare DSH. There are Medicare DSH add-on payments that hospitals who qualify will receive on each Medicare traditional inpatient claim. And the higher a hospital's Medicare DSH percentage, the higher its add-on payment on each inpatient claim. Now, in addition, Medicare DSH can affect certain hospitals' qualification for the 340B drug program. And that's because many hospitals are required to meet a certain DSH percentage threshold to qualify for 340B drug discounts. And as many of you know, the 340B drug pricing program allows hospitals who are eligible to purchase outpatient drugs from manufacturers at significantly discounted prices. So this is an area that can have a large impact on some hospitals' finances. And that leads us to our first polling question.
Thanks. Okay, so our first question is, how likely is OB3 to impact your facility's ability to qualify for the 340B drug pricing program? Very likely, somewhat likely, not very likely, not at all likely, or not applicable or unsure. Remember, you must fill out the polling questions to receive CPE credit. You will have 30 seconds to answer. Thank you for participating in our poll. Now back to Ramzi.
All right, thank you, Jennifer. So it looks like I'm seeing the results here that we're having. It looks like somewhat likely and very likely sums up to about 55 or 56%. So it looks like a lot of you have joined are anticipating somewhat significant or significant impact from this. All right, so we've gone over OB3's impact on provider taxes, state-directed payments, and community engagement requirements. So those provisions could have potentially the most impact, but let's go over a few of the other provisions, starting with retroactive coverage. So this is effective January 1st of next year. But currently, as of now, a new enrollee in Medicaid can receive retroactive coverage for up to 90 days prior to their application. But as of next year, that will be reduced to 1 month for the expansion population and 2 months for the non-expansion population. Now, another provision relates to cost sharing. That doesn't go into effect until 2028, but states must impose cost sharing of up to $35 per service for certain expansion adults with certain income levels. There will be some exemptions and some caps on out-of-pocket expenses. And states can also impose higher cost sharing for non-emergency hospital services. Additionally, there's a provision for erroneous Medicaid payments. So that doesn't go into effect until 2030, but states could face FMAP reductions. Again, that's the federal matching assisting percentage reductions if their Medicaid payment error rates exceed certain thresholds. So if there are errors related to, giving payments to ineligible individuals or insufficient eligibility verification or overpayments to eligible individual, all of those will have certain thresholds. And if they are above that threshold, they could face FMAP reductions. So there's a few final provisions that I'd like to briefly discuss. First is in 2024, there was a nursing facility staffing rule that went into place that required minimum staffing levels for nursing facilities, and it also required 24/7 RN coverage. Well, as part of OB3, there's been a moratorium on the enforcement of that staffing rule, and that moratorium is in place through 2034. In addition, OB3 will eliminate certain enhanced federal matching for emergency Medicaid services for some non-citizens. That will begin later this year. OB3 also will create new state options for states to expand their HCBS, which is home and community-based services. And those are essentially long-term care services that can be provided in a person's home or a community setting rather than in an institutional setting like a nursing home. And finally, OB3 requires CMS to certify the budget neutrality of the Section 1115 waiver programs. So for some context, the Section 1115 waiver programs allows states to test new Medicaid policies that may differ from existing federal rules. So as we've discussed today, Medicaid has some strict federal rules for eligibility, benefits, payments, but these waivers allow state to deviate from those rules legally after they've obtained CMS approval. And after obtaining that approval, the federal government will pay its share of the FMAP. Now, historically, these programs were always required to be budget neutral, so really that's not new, but OBBBA formalizes this requirement by requiring CMS's actuary to certify the budget neutrality of these waiver programs. So now that we've talked about many of the spending cuts related to OB3, let's go over a few visual representations of the federal spending cuts as projected by the Congressional Budget Office. So the CBO estimates that total spending reductions as a result of OB3 will total over $900 billion over the next 10 years. And what this graph is showing you is when those cuts will go into effect by year. Now, as you can see on the graph, we've barely gotten started with the impacts of the cuts. Through 2026, it was projected to be about 17 billion. The vast majority of the cuts, over 3/4 of the cuts, are projected to go into effect between 2030 and 2034. So this next representation shows the spending cuts by program, and then it's a little bit hard to see, but on the left side there, it's for the expansion states, and then on the right, it's for all states. But for the expansion states, which are those that expanded Medicaid coverage under the Affordable Care Act, the largest impact is the community engagement requirements. There's over a $300 billion federal spending reduction as of those, followed by provider taxes, which is over 100 billion there. Now, for states as a whole, the limits on state-directed payments is going to be about 150 billion, and then followed by eligibility rule impacts and provider taxes. Now, we have one more representation here, and this shows the Medicaid cuts over the 10-year period, which is 2025 through 2034, as compared to an existing baseline of federal spending. So the dark blue states are the states where the federal spending will decrease the most as compared to the baseline. Then you have the lighter blue, which is the next most. Then you have the teal green, which is a little bit less. And then the light green is the states that are least impacted by these spending reductions. And this leads us to our second polling question.
Thanks, Ramzi. Our second question is, which OB3 related spending cut will impact your facility the most? Provider tax limits, state-directed payment limits, community engagement requirements, FMAP reductions for Medicaid payment errors, or none of the above or unsure. Please remember you must answer the polling questions to receive CPE credit. You will have approximately 30 seconds to answer. All right, thank you for participating in our poll. Back to the presenters.
All right, thank you, Jennifer. And it looks like we had a very close race here. We had 40% were not sure, but we had a clear winner of the people who were sure. We had about 40% saying state-directed payment limits would be the most impactful. All right, well, now that we've covered OB3's impact on several different Medicaid programs, I'm going to pass it over to Patrick Birmingham, who will discuss the state tax implications.
Thanks, Ramzi. Appreciate that. Hello, everyone. So we are going to dive in and talk about some state tax implications. So on this first slide, we are going to look at the fiscal shock, and that's what states are up against. So a very high-level overview of what Ramzi has talked about. There's a projected over $900 billion of federal Medicaid cuts over the next 10 years. The three largest buckets that are going to make up this $900 billion is the community engagement requirement, which is about $330 billion, state provider tax, which could be as high as $190 to $230 billion, and then $150 billion will come from state-directed Medicaid payments. So because of this lack of flow of federal funds, states are projecting, all 50 states are projecting over the next 50 years that there will be a budget reduction of $664 billion. And because of this, an estimated 7.6 million Americans are expected to lose Medicaid coverage by 2034. As we just saw a second ago in that chart that Ramzi showed us, 20 states are expected to see Medicaid budget reductions of 5% or more. A few states, Arizona, Iowa, Nevada, are going to face reductions exceeding 15% of their total Medicaid budget. And then two states we're going to do case studies on, California and New York, will see the largest overall reduction of about $112 billion and $63 billion respectively to their state Medicaid budget. Medicaid expansion states with extensive use of state-directed payments and provider taxes are going to face the largest budget impacts. And on the flip side of that coin, states that are not heavily reliant on state-directed payments and provider taxes will not see as much of a deficit to their overall Medicaid budget. So what does this mean? All states operate under a balanced budget requirement. So there are three options. They can cut spending. This is going to be in either essential or non-essential programs. So states are going to have to be put in the predicament of either identifying programs they deem non-essential and cut spending entirely to that program to make up for their Medicaid budget deficit, or what they're going to have to do is identify essential programs, maybe something like education or security or SNAP programs, and partially cut spending from them to backfill this deficit. The second option is they can raise taxes, which we're going to be spending most of the remainder of this presentation talking about, or they can tap into reserves. Reserves are essentially a break glass in case of an emergency fund. So how these come about is when there is a program in a state and it brings in more revenue than the state predicted, the excess revenue is set aside and it's put into something called a reserve. And a state can tap into this reserve if it has a budget crisis or any other identifying need that it needs to use those reserves. So this is a little bit more detail on that last bullet point, how states are fighting back. We're going to be spending a lot of our time on this far left green box, which is the wealth and high earner taxes. This is going to be taxes on the top 1 to all the way to the top 0.0001% of citizens in each state. This is going to be taxes on millionaires and billionaires. There's a few ways states are using this. They're doing a one-time wealth tax, which is going to be a tax on the wealthiest individuals in that state. They could also do an annual wealth tax on those individuals. States are increasing the income bracket for the top earners in that state, and they're also increasing the capital gains tax for top earners in that state. Both these they are calling surcharges. The second way is through the budget and spending measures we just discussed. So they can draw down on those state reserve funds or those rainy day funds. They can cut non-essential programs or essential programs. They can partially cut spending to there. They can also narrow the eligibility criteria for citizens in their state, so they have less of a spend if there are less citizens eligible for Medicaid in that state. On the structural and legislative side, they can decouple from the OBBBA tax provisions. A very quick example of this is, say you are a corporation in a $1 million loss because you utilized the federal bonus depreciation and took 100% bonus depreciation. Some states decouple from this, or another way to say it, they do not conform to bonus depreciation. So to keep the math really simple here, how that would work on a state tax return is you would start with your $1 million of taxable loss. You would add back your $2 million of bonus depreciation, which the state does not conform to, leaving the state now with leaving the entity, with state taxable income of $1 million. Let's say there's a 10% tax rate in that state. A state now can receive $100,000 in tax revenue simply by decoupling from a federal provision within the Internal Revenue Code. They can pass emergency budget legislation. This is what we're seeing right now with creating new taxes, creating new reserve funds, or they can also use state constitutional amendments. This is more of a long-term structural fix to the healthcare system by changing the law instead of changing, tax rates or having one-time wealth levies or anything like that. So multiple different areas the states can do. Some of this will be simultaneously. Some states might lean more heavier on the green bucket here, which is the wealth and high earners tax. So with that, we are immediately going to go into a pop quiz polling question here. So I will hand that to Jennifer to take that away.
Thanks, Patrick. Our third question is, under OB3, which state is projected to have the largest impact on Medicaid budgets? California, Tennessee, Texas, New York, or Florida? Remember, you must fill out the polling questions to receive CPE credit. You will have approximately 30 seconds to answer. All right, thank you for participating in our poll. Back to Patrick.
Thanks, Jennifer. So yes, a lot of us got that question right. Close to 70% got that question. California is supposed to have the largest budget deficit, which is approximately right at $112 billion. So that segues us perfectly into our next slide, which is how is California going to combat this? So we're going to do a case study of the California billionaire tax. I'm going to start with some facts on the right and then move back to talk about some of the numbers on the left. But starting on the right, this was something that was very heavy in the news back in 2025. So there was an initiative brought forward by the SEIU UHW, which is a healthcare union in California. And a little bit of a tidbit on California politics. If a union or other organization has an initiative they would like to bring forward and bypass the state legislative process, they can bring forward an initiative and get signatures towards that initiative. And to have a initiative get on the ballot, and once it gets on the ballot, it's voted on via proposition, you need 875,000 signatures. The SEIU UHW collected 1.6 million signatures, so they nearly doubled the requirement to get on the ballot. So this proposition is going to be voted on November 3rd, 2026. And if there are more yays than nays from registered voters, which most registered voters are registered taxpayers who file taxes, this will be implemented. So this is a 5% tax on worldwide net income, excluding real estate directly held by the individual. The valuation date would be as of December 31st, 2026. How this works mathematically is, let's pretend for a second I am a billionaire and my net worth is $1 billion exactly down to the penny. Let's say $950 million is from assets I hold in publicly traded securities. Let's just say it's all in meta stock. We can easily identify that my net worth is $950 million due to publicly traded stock. I have $50 million of real estate in California. Let's say I have a primary home and a secondary home on the shoreline somewhere. I would not be subject to this tax because even though my net worth is $1 billion, we do not include real estate directly held. So what are these funds going to be earmarked for? That's going to be Medi-Cal, which is the state Medicaid program, K through 14, grade level 14 education, and then SNAP, food assistance program. SNAP is supplemental nutritional assistance program. So the best way to think about this is EBT or food stamps. This had some pretty big pushback, bipartisan opposition from the current governor, Gavin Newsom, current Republican leaders in the state, and also prominent business groups on both sides of the aisle. The biggest concern right now is prominent business leaders are either going to A, individually move out of the state, or B, individually move out of the state, then plus take their business out of the state. So they're very worried about out-migration from California into other states. We're going to pause on this last bullet point here, and I'm going to jump back to the top left, and we'll touch on that in a second. But again, this is going to be a 5% one-time levy on a net worth greater than $1 billion, excluding real estate directly held by that individual. The eligibility date is if you are a resident as of 1/1/26, or another way to think about it is if you were a California resident at the end of 2025, you could be subject to this tax depending on your net worth. There are roughly 200 individuals which are being projected to be subject to this billionaire's tax. These 200 individuals, of course, make up some of the wealthiest people in this country and in the world. The revenue target is $100 billion over the next 5 years. So we're going to jump back down to that last bullet point. So the state is projecting $20 billion a year. On paper, it could be higher because, of course, California would love if you pay this entire tax up front, but they may have an option, or they have an option, they may take it if they would like to pay this over 5 equal installments beginning in 2027. California is kind enough to slap them with a 7.5% deferral charge, which is more like a penalty on any unpaid balances every year until the entire amount is paid off at the end of that 5 years. So the Medi-Cal shortfall is right at 110 to 112 billion. So the revenue target is going to get close to making it up, could make it up with that 7.5% deferral charge, but not sure if it's going to cover the whole windfall. Quick tidbit about these 200 individuals, they make up approximately $2 trillion in wealth. So there is a very, very large concentration of wealth in California. So we're going to spend the next few slides here talking about some legal and economic risks that may come with this. So there's 3 large legal risks I want to talk about. So the first one is going to be the due process consideration raises retroactivity challenges. So again, just as a recap, the tax would apply to residents, a deemed resident as of 12/31/25. This billionaire tax would not be enacted until November 3rd of this year, so in a few months, when it gets voted on, and it has to be more yays than nays. And then the valuation date on businesses, stock, any sort of appreciating assets that make up someone's net worth would be on December 31st, 2026. So why is this important? Legal scholars are saying this could violate the due process clause because you are assessing a tax on a retroactive resident and you're valuing the assets a year after that residency is established. Another hurdle is going to be the dormant commerce clause. So the argument here is California residents are going to say that they have been unduly burdened to pay this tax and they're being discriminated against because they could claim that their wealth was earned outside the state of California. So that could look like is I am a California resident, I live there, but I have been able to prove between tax filings and what other support they have that all of my wealth was started, created, accumulated, appreciated outside the state of California. So the California resident is going to say, why is California subjecting me to a worldwide net worth tax when none of my wealth was earned inside the state of California? The last legal hurdle is going to be the primary residency cutoff. And what this is going to mean is California may make the claim that billionaires who left before the end of 2025 could still be deemed as a resident. So there's rumors to be a 31 bullet point checklist for California to determine if you are a resident. This is going to start with very simple questions as where's your primary home? Where do you spend most of the time? If you have a secondary home, is it also in the state of California? It's going to get more granular as you go on the list. 2 things that stand out are they're going to check where your doctor is, your primary physician. So if you left the state of California, but your primary physician is still in California, the state could argue that you are still a resident because for 99.9% of the population, most individuals live in a relatively close proximity to their to their physician, and they are a resident of that state because they want to be close to their physician. This doesn't count for, individuals who may have a very extreme case where they need to see a doctor outside of that state they're living in. But this is one of the claims California can make. The last one, and this is, very personal to me as I'm a huge golf fan, is California is also going to look at where your country club memberships are. So California is a very beautiful state and has a lot of very exclusive, wonderful country clubs like Pebble Beach or Cypress Point. California is going to look at residents who moved out of the state but kept their country club memberships to determine if they are a resident. Because again, similar to the physician's point we just talked about, most individuals who belong at a country club live in a nearby proximity and are a resident of that state because they want to take advantage of the golf course and other amenities within that state. So moving on to some more economic debates about this. So again, the projection was $100 billion over 5 years from roughly 200 taxpayers, but the Tax Foundation warns that yield could be far lower. This is looking at a study in 2012, Proposition 30 was passed in the state of California, which increased the tax rate for the highest earners in the state. Tax earners reduced their taxable income by roughly 10% through behavioral changes and outmigration. And when we looked back at Proposition 30, 61% of the projected revenue was eroded within 2 years, mostly from those who remained a California resident. So what this means is it was through behavioral changes. So you can do really two things to behaviorally change your income level. You can attempt to shift legally your income into different states and have those taxed in different states, or you can turn off your revenue stream entirely. So an example of this would look like is, I'm a California billionaire. I have a very beautiful home. I have a second home that I do not live in. I rent it out for $10,000 a month for the entire year. That's $120,000 of additional income. Let's say that put me in a top tax bracket. I don't want to pay that tax stemming from that top tax bracket. I also don't need that $120,000 a year because I'm successful and well off. So what those top earners did was they just said, well, I'm not going to rent this house out anymore. And they have reduced their income through a behavioral change. A little bit more on the valuation side, 72% of the wealth of California billionaires is in the form of publicly traded stocks. We gave the example of, owning Metastock in this previous slide. So it's very easy for California to see at the end of this December where most of the wealth is going to be generated from these billionaires. Private businesses are a bit different, obviously, because they're not publicly traded. The state has already come up with a formula of how they're going to assess the valuation. They're going to take the book value of the company, which is the sum of all assets in the business, plus 7.5 times the annual book profits, and that's going to be the average over the most 3 recent years. So add all that up, that's going to be your valuation. You multiply that by your ownership if you do not own 100%, and that's how California is going to value your net worth in a private business. So the question is, how is this going to be paid for? They're going to pay in cash. There's 3 ways to get the cash. The first way is going to be they just have it on hand. Some of these extremely high wealthy individuals are liquid and would be able to pay this all at once, or if they may want to defer it over the next 5 years, but incur that 7.5% charge. There are 2 other ways to get the cash that both of these are going to have secondary economic burdens. They can sell stock or they can borrow against the value of their wealth. So what this would look like is they could sell their stock. The secondary burden would be they would have to pay capital gains on that. They could also borrow against the value of their wealth, but it's difficult because if they borrow against a tranche or portfolio of stock that is not, say, dividend bearing and not paying them cash dividends, they now have 2 cash outlays. They have interest payments to the bank, and they also have they have tax payments to the state of California. So a lot of secondary economic burdens that may not be considered as much as just trying to get that revenue in. So all to be said, there's going to be multiple legal, economic valuation hurdles. The thing about wealthy individuals is they have a lot of money and they're going to spend a lot of money trying to combat this to the best of their ability. Really quickly, not going to spend as much time on this case study as we did California. This is just a more interesting initiative that's been passed by a state, or I guess more specifically a city, that's not just a pure income or capital gains tax, but this is the New York City, pied-à-terre tax. And what this is, it's going to be an annual surcharge on non-primary New York City residencies. So there's 2 different thresholds depending on what class type you're in. So the example here, the market value of $1 to $5 million, that's going to be for class 2. So you are going to see, depending on the fair market value of your property, a tax rate of 4 all the way up to 6.5%. If you are in class 1, which is going to be single family homes, 1 to 3 family residences, you will see a rate of 0.8% all the way up to 1.3%, with that threshold starting at 5 million and going all the way up to 25 million. It's proposed to affect around 10,000 properties. We just talked about the rate structure all the way down from 0.8 up to 6.5%, depending on your class. It's projected to bring in $500 million a year. The 3 key exemptions are if you are a primary New York City resident If you have a second home and you still live in the city, you would be subject to this unless you are renting that out and the renter, that is their full-time primary resident, or you are either renting it out or letting your family stay for free, and that is their primary residency. So this recently passed and is set to expire in 2031 unless it is renewed. So what are other states doing? I'm going to talk about a few right here. Washington has just imposed the first ever statewide broad income tax. So that's going to be a 9.9% income tax on household income greater than $1 million. This was just signed into law recently and will be effective starting 2028. It is projected to bring in $3.5 billion a year by the end of 2029. Two things about this. Let's go back to 2020, say time travel. Washington did not have any sort of income tax at all. In 2021, they passed a capital gains tax, which caused the outmigration of Jeff Bezos. And so with the passing of this now broad income tax, they're worried about outmigration of very wealthy individuals. The one good thing about this is there is a $1 million standard deduction. So if I am a high earning individual and if I earn, $1.1 million of income, we subtract the $1 million standard deduction, I would pay 9.9% on 100,000. So I'd have roughly $10,000 of tax that would be owed to the state. Minnesota and Rhode Island are attempting to follow in California's footsteps and propose a annual wealth tax. Minnesota used HF 4616 for a 1% annual levy on taxable wealth greater of $10 million or more. This would affect approximately 5,600 Minnesotans and would have generated $300 million a year. This was voted on and failed. Minnesota Democrats are eager to have a revote on this to see if they can get it passed. Rhode Island, this is a very new package and it's going to be voted on after the summer recess. It's called the Fair Share Package, and it's going to be a 1% annual wealth on financial assets greater than $25 million. It's going to be projected to bring in $650 million a year. Maine just raised their top income tax rate to 9.15%, raising competitiveness concerns. This would be one of the highest tax rates in the country, and that's the competitiveness concern is high wealthy individuals are going to leave the state because of this. Maryland passed 3 different new taxes in a 2025 tax package. This was a 2% capital gains surcharge tax. So capital gains are going to be subject to an additional 2% tax, a new 3% digital services tax, and they've raised their top marginal tax rate to 6.5%. You can see the competitiveness concern here. Maryland's top rate is 6.5%. Maine's is almost 3 percentage points higher than that. Maryland's is this tax package is projected to raise close to $600 million a year. And with that, I'm going to hand it over to Jennifer for our final polling question.
Thanks, Patrick. Our fourth question is, California's 2012 Prop 30 eroded approximately 61% of projected revenue within 2 years. What was the primary driver of that erosion? Mass outmigration, most affected taxpayers physically left California, behavioral changes by high earners who stayed, a court ruling that invalidated the rate increase retroactively, or federal deduction changes that offset the state tax increase for most filers. Remember, you must fill out at least 3 polling questions to receive CPE credit. You will have 30 seconds to answer. All right, thank you for participating. Now back to Patrick.
Thank you, Jennifer. So the correct answer there was going to be B, which 33% of the audience got correct. That's going to be behavioral changes by high earners. Again, that's going to be shifting income out of the state or reducing taxable income. And we gave that rental example as how you could do that. So we're going to spend the next few slides in a very apolitical fashion talking about the argument for and the argument against higher state taxes. You could also see this as pros and cons. So going to start on the pro side, or the argument for higher state taxes. The first one, which we've been talking about essentially this whole presentation, is preserve healthcare access. This is going to replace lost federal funding to keep Medicaid enrollees covered, hospital opens, provider networks intact, particularly for rural and safety net areas. The next argument is going to be progressiveness and equity and equality. My first day of my undergrad tax class, our professor said, the tax system in America is a progressive system. The more you make, the more you pay. So what this says is wealth and high earners, the burden is placed on those with the greatest capacity to pay. So the progressive system is attempting to target the narrowest population with the most concentration of wealth while leaving the middle class, those right above, at, or below the poverty line, generally unaffected. You try to put the greatest, the burden of the tax of those with the greatest capacity to pay. A very important thing is revenue stability. As you've seen from some of my slides and from Ramzi's slides, there is a decrease over the next 10 years of this in varying amounts. So having a tax that is brought into the state to create revenue is stabilizing the revenue and will help the state's budget for years to come and not have to, maybe have another one-off wealth levy. Address the balanced budget mandate. We talked about this. States have to balance their budget, and there's a few ways they can do it: either cut essential or non-essential spending, tap into reserves, or they can raise taxes. This has an effect outside of healthcare. I know this has been a very healthcare-focused presentation, but the more revenue brought in by a state has more options for them to, give back to the citizens in terms of employment, unemployment, better infrastructure, better uncompensated care costs. So when thinking about taxes, right now we're looking at through a healthcare lens, but bringing in taxes is good for all citizens in an industry and agnostic viewpoint. Arguments against higher taxes, we've kind of hit on these first two, and I know we're getting to the top of the hour, so I'll try to do my best to get through this in a quick fashion. Outmigration of high earners and also shifting of income. We gave the example of Proposition 30, where 61% of their revenue was eroded. Jeff Bezos moved from Washington to Florida after the 2021 capital gains tax. So a lot of states are worried right now about high earners leaving their states. Constitutional legal risks. We've discussed that wealthy individuals are going to fight against this because they just do not think this is a fair tax on them. They're putting an unduly burden on a small concentration of individuals to pay this wealth. Because of these first 2 points on this slide, we talked about revenue stability. There's also revenue volatility. So as the projections are higher than actual tax revenue received, states are now going to have to come up with other ways to raise revenue. Business competitiveness and investment. This is talking about business strategizing, where they want to set up shop. If you're a multi-state employer, you may not want to be in multi-state. You want to condense into one state, and you may not want to sell your business, or you may not want to start a business in a new state. Temporary versus structural fix. These taxes are a long-term temporary fix. It's a kind of a wordplay. For a structural fix, going back to the first slide we talked about, they need to go to the state legislative process to change the law to overhaul healthcare instead of using taxes as a way to help balance the budget. This is my last slide I'll run through really quickly, and it's kind of a recap of the last few slides on last few points on the previous slide. Multi-state employee and physician exposure. This is more on the employer side. Employers are going to need to strategize where they want to have employees and where they want to set up shop. Same for high earners. The second bullet point on the employee side, a certain employee who is a very high earner may choose not to move to Washington because of this new enactment of this 9.9% state income tax. Capital gains and liquidity events is talking about companies may decide not to sell their business. They may decide to kind of sell it off in tranches to limit capital gains, or they may decide to move out of that state entirely and then go on to sell their business. So I'm going to hand it over to Jennifer to wrap up. This slide is really just a summary of everything I've just talked about, but I know we are 1 minute past, so I will hand it to Jennifer, and I really appreciate everyone's time.
Thanks to our presenters, Ramzi Fadayel and Patrick Birmingham. Later today, you'll receive an email with a link to access their contact information, a copy of the slides, and a recording of the webinar. If PYA can help you with audit, tax, compliance, valuation, or transaction services, please contact us. You may also visit our website at pyapc.com for more details about specific areas of our expertise and to subscribe to receive PYA insights. Please remember to stay on the line once the webinar disconnects to complete the short survey for CPE credit. Once complete, your CPE certificate is downloadable via the CPE pane. If you've not yet registered for day 2, please join us. Use the link provided or visit the Thought Leadership section at pyapc.com. Now back to Catherine Good to close out day 1.
Thank you, Jennifer. And on behalf of PYA, thank you for joining us. We hope to see you again tomorrow for day 2 of the Summer CPE Symposium with 2 new sessions, Not All Practices Are Created Equally, Why Physician Practice Value Varies by Specialty, and AI in Healthcare Cybersecurity, Risks, Compliance, and Practice. Again, we hope to see you back tomorrow and hope you have a wonderful rest of your day. Thank you.
Thank you for listening to this PYA webinar recast. The video recording, slides, and associated material for this and all PYA webinars are available on our website. If you have any questions or if we can help, please contact us at pyapc.com. Thank you again for joining us and have a great rest of your day.